Welcome to Larkin-Gowan Insights, accountancy and business advice for all, a series that gives you bite-sized tips and guidance on tax, funding, legislation, reforms and much more. With case studies, business advisory and sector specials and even interviews, our team of experts are committed to helping you navigate the world of accounting and finance with a variety of presenters from across our specialisms. So, let's get on with today's show.
Hello and welcome. Thank you for joining us. My name's Gillian McGill. I'm a VAT Director at Larkin-Gowan and I'm joined today by my colleague Dominic Carter.
Hello.
We are going to be talking today about the latest updates that were released by HM Revenue and Customs in the spring and a little bit of an update and reflection back on the tax roadmap that was issued by the government last year. So Dominic, if we start with the corporation tax measures, what have we learned recently?
Well, as you say, Julie, this follows on from the corporate tax roadmap, which the government announced at the last budget with a view to instilling confidence that corporation tax regime was going to remain broadly stable and preserve some of its most attractive features for companies. The emphasis of the tax update in the spring was around simplification and modernisation, addressing non-compliance, making the system fairer. So from a corporate tax perspective, there are probably three areas which are worthy of the greatest attention. These are probably more relevant to larger corporate entities than most SMEs, but they do play an important part in the tax system and collection of taxes. So the main areas are around transfer pricing, permanent establishment, and the diverted profits tax. And I'll just take a moment to explain what those are. They may not be points which are instantly recognisable to listeners.
But the lofty aims of this update did mention simplification and reform, so I'm sure that will be coming to point.
Hopefully that is the case. Transfer pricing, or TP, as tax practitioners call it, is basically the part of the tax regime that deals with arrangements and transactions between companies that are connected, with a view to making sure that they are fairly priced so that the correct amount of profits arise in each company and the right amount of taxes is therefore paid. See, a particularly key area where you have companies that are subject to tax at different rates, or where one of the companies is in the UK and another one isn't, where there'll be questions of are the UK taxable profits correctly measured. Permanent establishment is another matter which our clients who are either overseas coming into the UK, carrying on business in the UK, or UK businesses are looking to go overseas and trade overseas have to grapple with. And the point there is really that if you have a permanent establishment in the UK, if you're an overseas entity, you will be liable to UK tax on the profits attributable to that permanent establishment. And likewise, because there is a broad international consensus about how these things should be done, and other countries enact similar laws and enter into tax treaties with the UK, you would find that if you were going overseas, you would have to be very aware whether or not you were creating a permanent establishment in the overseas territory, which would bring you into tax overseas.
So that needs to be understood at the point at which you're forming those plans, really, to perhaps expand overseas, because an unexpected tax liability or indeed just a tax reporting obligation might undermine your whole commercial rationale.
That is absolutely correct. You've got to understand before you take these steps, if you are a UK company that's looking to trade in France or Germany or wherever, whether you're going to have an obligation to pay tax on those activities overseas. Fortunately, because we're in a modern world, there are tax treaties and aspects of UK tax law that will provide for relief against double taxation, but you still need to understand where you're paying tax, what your obligations are overseas, what they are in the UK, and of course you could find that you are paying tax on at a higher rate on profits because the rate in the overseas territory is higher than it would be when you mistakenly thought you would just be paying UK tax. So it does have very important implications to be considered at the planning stage and forever thereafter, because we know what businesses are like in terms of they evolve, they change, sometimes processes change and things, and permanent establishment rules will consider factors like, have you got somebody overseas who's able to act in a particular way and work towards the conclusion of contracts, and we know that these arrangements can change, over time. So absolutely need to be taken care of or taken into consideration at the outset and on an ongoing basis as well. And the final aspect of the UK's international tax regime that is being consulted on, along with TP and PE, lots of abbreviations, is another one, the diverted profits tax, or DPT, which is probably a more marginal consideration for many of the clients we work with, and is predominantly focused on large multinational enterprises who have got fairly complex arrangements in place to try to avoid UK tax, either by the way that they transact with other companies in their group, or perhaps through trying to avoid creating a UK permanent establishment. And the DPT imposes a higher rate, effectively a penal rate of corporation tax on the diverted profits. So those are those regimes. As I say, at this stage it is a consultation. It's a consultation which is intended to fulfil the government's commitment from the last budget of consulting with business and interested persons on these matters, but actually it goes back further than that, because there were previous consultations carried out by the previous government in 2023. So this is part of really trying to hone in on what the changes are going to be to these regimes. Generally speaking, there's a lot of technicality around these changes, which are clearly important to us as advisors working with businesses. But really, probably the best one is in relation to transfer pricing, where at the moment companies in the UK transacting with other connected UK companies still have to consider the pricing of their goods and services and arrangements for TP purposes, and that brings with it a degree of administration and documentation typically, and for HMRC often there'd be very little risk of tax being underpaid in the UK, because you would have two companies both in the UK paying tax on all of their UK activities at the same tax rate. So you could say, why are HMRC keen to involve themselves in that? And broadly they're not. And this is the driver behind this really. Can they look to take companies who are very low risk to HMRC out of the burden of having to carry out detailed work to establish an appropriate transfer price for their intercompany?
So that there's no potential tax reduction for HMRC by this particular proposal, but there could well be massive gains for taxpayers in not having to maintain this burden of administration and bundle of evidence to prove something.
That is absolutely right. I mean, I think you can rely on it. There's going to be little tax actually spared as a result of it, and there'll be lots of measures in there to make sure that there aren't situations where tax is saved, but the relief from a potential administrative burden there is, I think, very, very helpful. I think that's probably the main change that we will note and our clients will note. Many of the other changes to all of those regimes are going to be looking to make technical improvement, maybe simplification, perhaps addressing unfairnesses. But yeah, again, they are mainly at that type of a level. And if anyone is particularly excited by these areas, I should point out the consultation runs until 7th of July, so there is still time to make your views known to HMRC.
If you feel strongly.
Should you wish to do so, yes.
So other good news, perhaps, with respect to reducing taxpayers' burden for administration was with respect to benefits in kind, wasn't it, Dominic?
It was. I share your hesitation as to whether that is a genuine positive. What employers were bracing themselves for was a need to payroll benefits in kind from the 6th of April of 2026, so next tax year.
So less than a year away.
Less than a year away. We were getting very close to that. At the moment, we have for anyone who hasn't early adopted the payrolling of benefits, we have a system whereby benefits in kind are generally dealt with through Form P11D, which is produced by the employer, given to the employee, and reports the benefits that they've had, which are taxable, and then the individual will incorporate those in their self-assessment tax return. The company will pay the national insurance that arises. So that's the current regime. It's an annual event that takes place after the tax year is completed. Payrolling of benefits means that apart from two or three of the most complicated benefits in kind, which will be left outside of the regime initially, everything else has to be payrolled, dealt with in real time throughout the tax year. So that would be a considerable change. I think, Julie, our experience is that for people who have early adopted, they've actually found it quite a good process, and the antiquated once-a-year paper-based exercise is maybe not something that will be lamented. So the announcement of a deferral of that through to 6th of April 2027, as you indicated, I think is a mixed blessing. If you like to adopt things at the last minute, or only when you absolutely have to, then you will appreciate that. If you've got other things going on in your business that are taking up your time and attention in the intervening period, likewise. But it is well worth considering whether to early adopt. We have clients who've done that this year, and I think when we get through to next year, again, it would be a good decision point for people to think about whether they get on that bus a year earlier than they need to.
Yeah, because that deferral is really just kicking the can down the road. It's not as though there's any change to what you're going to have to do. You're still going to have to undergo the same process to get up and running. It's just you can ignore it for a little bit longer if you're so minded to.
That's absolutely right. It's definitely coming. It's just coming a year later now. And certainly for anyone who's already braced to deal with it and had taken advice and so on, got themselves ready for it, I wouldn't see any point in deferring it a further year. But
so staying on the subject of employment taxes, something that has already taken effect were changes to the CEST tool. They've already come in, so they're live and kicking as from, I think, May.
Yes, that's right. And the CEST tool is the Check Employment Status Tax tool, which is made available by HMRC. And some businesses in particular have to regularly consider the people that they engage and whether they may be employees rather than self-employed. That will go down to the nature of the contractual and business relationship between the engager and the employee or self-employed individual. The CEST tool, in some form or another, has been around for a long while, and you can, as an employer, you can use that to check the status of the individual, and it has been changed, modified, improved over time. Initially, I think it just produced the answer that everybody was employed, but it is more capable of nuance now and interpreting the different situations that arise. And it certainly, if you are somebody who engages people and there is any doubt as to whether someone is genuinely self-employed rather than employed, that is something you should be aware of and should definitely be considering using. HMRC will expect you to have done so if you are then subject to a status inquiry.
Yeah, and HMRC will run the same checks on those people even if you haven't, and they've stated quite clearly that they will stand behind the results that the CEST tool throws out. So if you haven't taken advantage of the opportunity to do that check yourself, then you're just putting yourself on the back foot, I think, should HMRC ever look at you.
Completely agree. And Gilly, your area of specialism is VAT, and there's quite an exciting change, I think.
We think it's exciting. Proposals, again, I suppose on the theme of removing some administrative burden for taxpayers, proposals to increase the capital goods scheme threshold, which has not increased since 1990, so definitely a stealth tax if ever there was one. The suggestion is that all computers will now no longer be within the capital goods scheme, so anybody who is planning to buy one large piece of computing equipment, which is highly unusual these days, that won't be a capital goods scheme item. And the threshold for land and property spend going into the capital goods scheme regime will increase from 250,000 to 600,000, which is sounds like a massive increase, but in reality, £600,000 of spend on a building, whether you're buying it, constructing it, refurbishing it, extending it, is still not an awful lot. So there'll still be quite a lot of land and property that's within the CGS, but nevertheless, the changes are welcome, I think.
And Gilly, so people who are within CGS will know very well what that is all about and the risks that it poses. But by way of a brief recap, if there's anyone who isn't aware of it and aren't involved in it, you've explained certain type of assets fall within it, but what are the implications of being within the CGS regime?
So potentially you could have to adjust your VAT position annually for a 10-year period. So that could be catastrophic for you. What you'll be doing is saying, I've spent this money on this building, I've recovered the VAT on it because I'm going to use it entirely for making vatable supplies. But every year for the next 10 intervals, you're going to have to check whether your use of that building has changed at all. And if you carry on using it as you first did, that's fine. No changes will need to be made to your VAT recovery position. But if you change how you're using that building and you start to make some exempt supplies, you'll have to repay some of the VAT that you originally recovered. So that could make that building suddenly less commercially viable. The one that really catches people out, I think, Dominic, and this is where you and I have often seen CGS rearing its head, is if the building is going to be sold within that 10-year period, because the sale of a building is probably going to be an exempt sale, and that will crystallise a big VAT clawback for HMRC if you don't take action and you don't take steps to make sure that sale is actually taxable and not VAT exempt. And that can often come up last minute on transactions, something that perhaps hasn't been foreseen and can really throw a spanner in the works.
That's really crucial, isn't it? And we have seen that quite a number of times. So something that as tax advisors and also for lawyers as well, they get very excited about, don't they, on property transactions. And given the VAT is at 20%, it can have a huge impact, can't it, where people are unaware of that at the time they transact. So thinking about some of the other things that have been promised through this process, Gilly, there's going to be less paper floating around, isn't there?
Apparently so. We know a lot of countries are already either mandating or considering mandating electronic invoicing. And this is something that the government has consulted on for the UK. I think it's a matter of when it comes rather than if it comes, because that does seem to be the general movement around the world. So what electronic invoicing in a nutshell will do is we'll no longer have invoices either being posted or emailed or somehow transmitted between seller and buyer. Instead, both parties' systems will talk to each other, and the invoice information will be automatically imprinted into the customer's finance systems by the supplier. It sounds very whizzy, it sounds brilliantly efficient. It will remove the need to, rekey data into systems, which should remove the prospect of human error there. But the reason why VAT people get excited about it in particular is because it's absolutely vital that the systems that are put in place ensure the correct rate of VAT is being sent on that electronic invoice by the supplier, and that the customer has a way of checking that the VAT they've been charged is correct as well. Now, if you're operating in a sector where everything's at 20%, that might seem dead straightforward, but that isn't the case for every business by any means. So as soon as you've got anybody who might be making some zero-rated or exempt supplies, you're going to have quite a sophisticated system set up to make sure that your electronic invoicing operates properly. So I don't think this will be the last time we talk about electronic invoicing, Dominic, and I think some of our colleagues may also be starting to think about that soon too.
Excellent. And HMRC are going to have a clamp down on the amount of letters they send to taxpayers as well, I gather.
Yes, they're going to remove a number of the particularly corporation tax letters that they send out via the post, which is frankly overdue, in my opinion. The postal system is a bit hit and miss at best for people receiving letters. Whilst we've got the government gateway available to taxpayers, it seems to me a much more efficient system to put information on that rather than relying on second class, because they still use second class post, to deliver a bit of paper through somebody's letterbox. So that's very welcome, I think.
That sounds eminently sensible. So one of the things that we've talked about, Gilly, as well, is the spring update, certainly for the sort of areas that I work in, is part of the government delivering on commitments that it made at the previous budget through the document they published as the Corporate Tax Roadmap. And I thought it'd be an opportune time to think about how we're seeing that process at this point. Just by way of a refresher, there were some genuinely good points in the roadmap because there are some genuinely positive aspects of the UK corporation tax system. So, for example, if we're comparing ourselves with other similar nations at 25%, whilst it's an increase on previous corporation tax rates, that is apparently still the lowest in the G7, and there's a commitment to preserving that. That's the main rate of corporation tax, and we have a number of other pleasing aspects of the corporate tax system. So when we are dealing with groups of companies, for example, and there are dividends paid between them, in principle those are usually exempt from corporation tax by the receiving company. And likewise, we often have groups who are active in buying or selling other companies in their group, and we have something called the substantial shareholding exemption in the UK, which exempts the selling company from on a disposal of shares broadly in trading companies. So those are really positive. We've also got a very broad-based and quite flexible system of loss relief within companies and groups, which is not necessarily the preserve of other countries. We now have full expensing for capital expenditure. Qualifying capital expenditure attracts 100% relief from tax in the first year, and we have, although it's been significantly modified, a system that supports research and development. And those are all elements that are committed to being retained as long as addressing some of the complexities around the particular items that we talked about earlier. So how is that going? Well, it's clearly a very early stage, isn't it? The aim is clearly to provide some confidence and stability in the tax system for UK businesses and as a part of our international competitiveness. I guess my main reflection on it at this point is corporation tax is not everything. In fact, it's not even the main consideration for a lot of people. Most of our taxes are raised by other means on income, employment, VAT on goods. So there is a wider picture there. We have factors such as the increases in national insurance that have taken place. Other perhaps non-tax measures but affecting employment, like the increases in the national minimum wage, which make it more expensive for some employers to employ. Aspects of the forthcoming Employment Rights Bill, which will perhaps make it more difficult to part ways with employees and therefore might make employers more sceptical about recruiting, as it involves a greater risk. So these are all things that we've picked up on in our conversations with clients and that play a part overall. And whilst moving well out of my area of knowledge here, it will be well known that there's been significant changes, in fact the abolition of the UK's non-domiciled regime, and speculation or perhaps early data as to how many people may have made a decision to leave the UK. And I guess relevant to us as well in our capacity as advising SMEs, probably increased conversations with our clients who are thinking about perhaps selling because of changes to the tax system, or perhaps winding up and retiring, more so than before. I mean, we don't truly know how all that picture's going to unfold, do we? And whether anecdotal conversations lead to somebody taking a significant step of emigrating, selling, or winding up their business. But I just wanted to reflect the fact that really the corporation tax commitments that have been made, whilst I'm sure welcome, are part of a wider picture that clearly the current government is going to have to grapple with and strike a balance.
Yeah, no, it's a fair point. Bit of a mixed bag, and it's not all down, as you say, to corporation tax, although some good headway made with respect to that regime. Thank you very much, Dominic. Thank you everyone for joining us today. If you have any queries or need any assistance with anything that we've discussed today, please do get in touch with us. Details are within the show notes. Thank you.
Thanks, Julie.
Thank you for joining us for Larkin Gowan Insights, Accountancy and Business Advice for All. Don't forget, you can find more information about today's topic and more about how our team of experts can help you in your business by visiting our website, larkin-gowan.co.uk. Join us again next time for another fascinating insight into the world of accounting and finance.